U.S. unemployment rate might be on its way down. The Labor Department reported today that the number of claims filed last week was the lowest weekly figure since November of 2008. And while the number of jobs is rising, the trade deficit seems to be shrinking. Scott Brown of Raymond James is a Bloomberg Best economist and ranks as the best forecaster of unemployment. He joins us now from St. Petersburg, Florida, to analyze today's numbers. Scott, welcome to Bloomberg News. Always good to have you on.
Nice to be with you.
Scott, what do today's numbers tell us?
Well, not a whole lot. This time of year, the week-to-week changes in jobless claims tend to be pretty volatile. It's a difficult job doing the seasonal adjustment. You got a lot of holidays in the last few months of the year, so you're going to see some swings week to week, and we have seen some swings week to week. You need to focus on the underlying trend there, and the 4-week average, just under 450,000. Is a moderately high level still. We really need to see claims coming down a lot more into below 350,000, 320,000 to really suggest that we're in a strong job market.
And also,
so at face value, the numbers I think are encouraging.
Yeah, but I guess that we also need to see an increase in the payroll figures too, right? Maybe that would give more impetus to this.
Yeah, and then the numbers we got last Friday were pretty good. We had a 151,000 increase in non-farm payrolls, 159,000 in the private sector. There, too, you don't want to look too much at any one particular month. The 3-month average for the private sector was at 134,000, which is what we would probably consider a steady state in the economy. That would be pretty good if we were at full employment. That pace of job growth is enough to absorb the growth in the working age population. But it's not enough to push the unemployment rate down significantly. You really need to see much stronger economic growth, much stronger job growth going forward. And it's still going to be, I think, a very gradual recovery.
Can we at least, for purposes of this discussion, say that the job market is improving, albeit slowly?
Well, we tend to focus on the net job gains, the net increase in payrolls, and there's a lot of job creation and destruction that goes on every quarter. We're adding and losing, millions of jobs. And I think what we're finding now is that the overall rate of job destruction is pretty low. If you look at announcements of corporate layoff intentions, those are trending, remarkably low at this point. What we have is a lack of new hiring. And normally we're going to look to small firms, essentially the newer firms in the economy, to really add a lot of jobs. And for a variety of reasons, that's not happening right now. And one of those reasons is tight credit.
And is another one of those reasons the political landscape as well? Maybe that shifting that we saw on Election Day, still some confusion about where this lame duck Congress and maybe the next Congress might go in terms of job creation and job growth.
That's certainly the case. I travel around the country talking to various groups, and that comes up very often, the political climate. Although businesses will complain just about anything, I think maybe the attitudes do improve, and at the maybe they'll be a little bit more encouraged to hire new workers going forward. But again, I think the bottom line is it's a very gradual recovery.
Scott, let's talk about the trade deficit because, we got word from Commerce today, trade deficit narrowing to $44 billion in September. That was from $46.5 billion a month earlier. What's the significance of that? Will it make an impact? Will it make a dent at all?
Well, the numbers here also bounce around month to month, so you need to be careful interpreting any one-month change. When you look at the depth of the financial crisis, we saw a very sharp drop-off in the trade deficit. It was more than cut in half. And as the economy in the U.S. has recovered, the global economy has recovered, that trade deficit has started to increase again. And so it's been a real concern. We saw imports rising pretty sharply in the second and third quarter. That subtracted from GDP growth, even though that's actually a sign of strength in the domestic economy. The more recent monthly numbers now suggest maybe that trend is starting to flatten out. So the trade deficit may not be increasing as much. That's welcome news. Maybe a bit softer dollar will help encourage exports and at the same time help restrict imports to some extent.
Sure, but there's still that huge gap with China, and on the eve of that G20, I guess we can expect some tensions, maybe perhaps not even a frank discussion of this at this time?
That's exactly the case. If you remember back to the 1980s, we had a similar issue with Japan. And we had asked the Japanese for voluntary export reductions. and they complied to some extent, and you're seeing very similar things now with Treasury Secretary Geithner going out last week and proposing that countries limit these external balances that we're seeing. I think this is critical that we do this over time, and again, a softer dollar may be part of that equation. But the trade deficit, the wide trade gap, was at least one contributing factor in the economic financial crisis. That is, when we were running huge trade deficits, we're running huge capital surpluses. So that money was flowing in largely into the bond market, into the mortgage-backed market, and that was pushing down mortgage rates and helping to fuel the housing bubble. So that was, at least one factor during the financial crisis.
All right, Scott Brown of Raymond James joining us live from St. Petersburg, Florida, with his expertise. Scott, always good to have you on. Thanks so much.
My pleasure.